Hello everyone, I am Hema pursuing MBA in Sri Venkateshwara College of Engineering. Today I am going to explain about financial accounting and reporting. The topic is generally accepted accounting principles, that is GAAP. Let us move on to the introduction. Accounting rules used to prepare and standardize the reporting of financial statements, guidelines which help the accountants in preparing the accounting standards in a such a way that uniformity and comparability in the accounts. GAAP is implemented through a measurement principles and the disclosure principles, that is ICAI, Institute of Chartered Accountants of India, is the body in the India. And the definition of GAAP. The generally accepted accounting principle are a set of accounting rules, standards, procedures issued and frequently revised by the Financial Accounting Standard Boards, that is FASB, and the Governmental Accounting Standard Boards, GASB. And move on to the meaning. Generally accepted accounting principles are basic accounting principles and guidelines which provide the framework for more detailed and comprehensive accounting rules, standards, and other industrial specific accounting practices. For example, the Financial Accounting Standard Boards uses these principles as a base to frame their own accounting standards. And the following are the general accounting principles are mentioned earlier. That first one is business entity assumptions. It starts that every business's entity should be treated as an entity that is separate from its owners. Therefore, all financial transactions should also be distinguished in a such a manner. This concept is especially important while recording financial transactions of a sole proprietor. When the entire business with its asset and liability belong to the proprietor, the financial transaction need to be distinguished between those related to the business and those related to the proprietor personally. And second one is monetary unit assumption. All the financial transactions of a business should be capable to being expressed in a monetary unit, that is Indian rupees. And if it is not possible to do so, then it should not be recorded in the books of accounts of a business. And third one is accounting period. This principle entitles the accounting process of a business should be completed within a certain period of time, which is usually a financial year or a calendar year. Thus, every transaction which relates to the particular accounting period will be form a part of financial statements prepared for that period. And the fourth one is historical cost concept. It means a general rule when certain economic resources or asset are acquired by an enterprises, they can recorded as per the cash or cash equivalent actually spent to acquire that resources or asset on the transaction date, even if the transaction happened in the previous day or 10 years ago. This it result in the value of remaining asset constant, irrespective of accounting period. And fifth one is going concern assumption. The business entity is assumed to be a going concern, that is, it will continue to operate on indefinite amount of time. This assumption is important because if the business entity were to liquidate in the near future, it would have a restate it assets and liability in the accordance with the actual amount that could be realized or payable as the case may be, so as to reflect the true financial position of the entity. And the sixth one is full disclosure principle. An accounting entry may not independently be able to provide all the relevant information relating to the transactions. Hence, the full disclosure principle requires the entity to disclose all the financial information relevant to the investors or users to assist him in a decision making. Matching concept. This concept requires the revenue for a particular period to be matched with its corresponding expenditure, so has to show the true profit of the period. Eighth one is accrual base of accounting. This principle requires all revenue and expenditure to be recorded in the period. It is actually incurred and not when cash and cash equivalents has been received or spent. The earning of the income and the incurring of the expenditure is important irrespective of the corresponding cash flow. And Ninth one is consistency. An entity may decide to follow a particular accounting procedure or a rules in a relation to series of transactions. Such accounting procedure need to be followed consistently over the following period, uh, for following accounting periods, so as to facilitate comparison of the result between two periods. Next, materiality. This accounting principles allows an entity to disregard another accounting principle if the result of the same does not affect the decision making of the users of the financial statement. And next is conservatism. In the process of accounting, one might come across various situations where there are two equal acceptable ways of accounting for a particular transaction. One might even have a choose between the recording transaction or not recording the same. In such a situation, a conservative approach should be followed. This is about a gap. And next, conclusion. In many situations, employees were able to twist statements which follow gap, that is generally accepted accounting principles. Employees were easily convinced they were doing the right thing. Anyone who was unwilling to participate was ignored. Substantial concern were not brought up until the um, scandal was out of hand. Thank you.